Hi guys. The title of this video, I think, is going to be indicator overload, or maybe it's going to be information overload. I'm not sure. But the point is the same, notwithstanding whatever the title ends up being. Um, and it's this. Oftentimes, you will see people who get into trading fall in love with indicators or a number of indicators, right? And many times you'll see their screens end up looking like this because they subscribe to the notion that if one indicator provides some insight, well then four or five or six or seven should really clarify the picture and give and basically stop you from losing any money at all. Nothing could be further from the truth, right? In fact, what will often happen is the more indicators you have, the more indecisive you become, because at the very moment that the moving averages are telling you, wow, this is a great short opportunity on a retrace, the MACD is telling you that you have a crossover to the upside, so you should be looking to get long. And the linear regression channel is saying, wow, this is a buying opportunity because you're in the buy zone here and you should be looking for this thing to move higher, while the ADX is telling you that this is not going to be a trend day because it's dropping and looking like it's actually already below 30, so it's not going to be a trend day. So, like, what do you do, right? In my opinion, what you should do, number one, first and foremost, for those who want to be traders, is limit the number of indicators that you use, right? I suggest that everyone who's starting limit themselves to basic exponential moving averages. And depending on what you're actually trading, you should really only use one, right? For example, your 401k. If you are doing something that's a little bit more active, then you can use the multiple moving averages to give you context, and then to suggest to you when there are opportunities, right? So for example here, this is the longest exponential moving average, this is the intermediate, and obviously this is the shortest, right? Both the intermediate and the shortest are below the long-term moving average, and it just happened this morning. So the price has obviously dropped down in a fairly aggressive way, and then you got this bounce, which is considered the retrace, right? And there's a potential short opportunity setting up, right? Now, if you, like you saw before with all of the other indicators, the linear regression channel is telling you that this is a buy area down here. You should be looking to get long, right? Um, um, the reality is your profitability is going to be a function of how much you can limit your risk. How small can you make the actual stops that you take, as long as you don't die, death by 1,000 cuts, your account anyway. How small can you get your stops to be, right? Obviously, relative to the wins that you actually get, right? That's going to drive whether or not you're able to be successful as a trader. Win percentage, which indicators you actually use, all that stuff, it's neither here nor there. Indicators, in my opinion, should really be called suggesters, right, or contextualizers, because that's all it's really doing. They're all based on the same information, right? The price of the security, maybe the volume, and previous prices, the high, the low, the close, those kinds of things. They're all like different configurations of the exact same information, right? It's just providing a certain look or feel to what's going on, right? But the basic price action should be driving your behavior. Right now, on this chart, on this 60-minute chart, we are officially in a downtrend. I don't know, maybe if I make it smaller, we might see that. Let's see here. We haven't broken. Yep, see? So now that provides a different context, right? This would be the relevant low, right? So you want to break this, right, before you say that you're getting at least a lower low. You don't even have really a lower high yet. This, you might want to consider this it if this ends up pushing down, right? But so you see, like the information can be interpreted in lots of different ways, depending on what you're looking at. What you have to do is narrow the focus, right? You want to narrow the focus so that, okay, this is what I'm looking at on an intraday basis. We broke this low earlier this morning, right? And now we've raced back up, and using this indicator, this is looking like it's going to set up as a possible short opportunity, right? If you get this to close and then you get price to trade below that, that will be your signal to get short with a stop just above here, right? Simple as that, right? Other indicators are saying something entirely different, right? So whichever ones you choose to use, you have to be consistent and use them, and don't jump around on indicators, because they will be telling you something different, and what you'll end up doing is whipsawing your account. Okay, I hope that's clear. The basic message is, don't overload your charts with indicators. Let the price action dictate your behavior, and only use indicators as a method of really kind of contextualizing price information. But ultimately, the immediate price action drives all. Okay, I hope this is helpful. Any questions, ask the trader at theartofsimpletrading.com. We'll see you at the next video.